What's going on, everyone? Week 3, understanding options. This is going to be one of the more complicated weeks to understand. There's a lot of concepts here. I'm going to do my best to explain everything. And we'll go into the Weeble where you would place option trades. I'll try and cover everything, but it's going to be a lot and a little bit hard to understand. Just putting that out there, but I'm going to do my best to explain it, and hopefully it's understandable for everyone. So, what are options? Options are contracts that you can buy on stocks that grant the ability to buy or sell a stock at a higher or lower price. So this is called exercising an option. I don't do that. I'll cover that later on in the video, what that means. But I don't exercise the options at all. I only trade them. So the price of options, they move faster than the stocks themselves. So for example, if a stock moves up 20 cents, the options can move up to 10% of their worth, making smaller moves more profitable for traders. So instead of buying a whole share of a stock for, let's say, $200, and then it moves up a dollar, if you bought one share for $200, you'd only make $1. However, if you buy option contracts, in that same $1 move, the price of the contracts for options could move up like 20, maybe even 30%. So instead of only making $1, depending on how much you put in, you could make 30%. So if you put in, let's say, $1,000 on one trade and it moved up 30%, that would be $300 that you just profited. Options, they're split into two different categories, I guess you could call them, calls and puts. So calls are when you're expecting price to move up, and puts are when you're expecting price to move down. So if I were to buy a call contract and the stock price were to move up, I would make money. However, if the stock moves down, I would lose money. But on the other hand, if I was in puts, they're the opposite. So as the price of the stock would move down, I'd make money. And if the price went up, I would lose money. So going over the strike price and then in the money, out of the money. It's going to be a little hard to explain here, but again, I'll go into what it actually looks like when you're trading it and explain everything over again, just so you have a visual. But so calls and puts, they all have a strike price. The strike price is relative to the stock prices. So if we're trading SPY, the S&P 500, and it's currently at $515. Then there will be strike prices at $513, $514, $515, $516, $517, etc. And below that and above that, all around. I don't know how far it goes in either direction, but they'll be at for SPY at least. It'll be at whole numbers above and below what the price of the stock is currently at. Depending where the price is, the strike prices will be in and out of the money. So what this means, so we'll go off the example that SPY is at 515. There will be contracts at 514, $1 below the current price. Since the current price is at 515, which is above the strike price, the 514 calls will be in the money. However, 514 puts will be out of the money. Now, if the strike price is 516, so above the current price of the stock, the calls will be out of the money since it is above the current price, and the puts will be in the money since the price is below the current strike price. So I know this is a little bit confusing here, the strike or in the money, out the money. So basically, calls, it's a contract to buy the stock at a lower price. So when the price is 515, right? The calls are at 514, right? You would want to buy the stock at 514 instead of the current price at 515, making it in the money. And then puts, on the other hand, that's when you want to sell it, right? So if the current price is 515 and the puts are at 514, you wouldn't want to sell the stock for $514. You'd want to sell it at $515, which would mean the puts are out of the money. So if the strike price was $516, The calls will be out of the money because you wouldn't want to buy contracts at 516. You would want to buy it at 515, the lower amount. And if you were selling, they'd be in the money because you would want to sell it at 516 instead of 515. A whole extra dollar you could profit when selling the stock. That's only, again, if you're exercising options, though, actually buying and selling them. But I don't do that. You need a lot of money to do that. Again, we'll cover that at the end of this briefly. But yeah, hopefully that understands in and out of the money a little bit better. I'll go over it again when we go into the actual Webull and what it looks like when you're trading. So all the option contracts, they have expirations. So they're when the options can be turned into actual shares or when you can exercise the options. You can't exercise the options until the date of expiration at the end of the trading day, which is at 4 o'clock. I do not hold to expiration, and I only trade them intraday, so like buying and selling within the same day, or at least before they expire. I sell it, and I'm out of all of them before they expire. Most stocks have weekly expirations, so on Friday of every week, they'd expire at 4 o'clock at the end. But bigger companies and SPY, for example, have contracts that expire every day as they have more volume and are more frequently traded. So since a lot more people are trading it and a lot more people are buying and selling, instead of just having expirations once a week, they have expirations every day. So 5 days a week, there's an expiration at the end of the day. I always trade the same day contracts because they have the most volume and movement. So in SPY, I always trade the contracts that expire at the end of the day because those contracts will move the most. So you'll be able to get the biggest returns in small moves. But if I were to trade like contracts that expire in a few days, when the stock price is moving, the price of the options wouldn't move as much. So theta, or time decay. When trading options, you have to be aware of theta. So theta is what's known as a Greek. It's a concept of time decay. So as the day goes, the contracts that are out of the money will slowly continue to lose their value. Because since they're out of the money, they're worthless. So the price of it will go down slowly as they become closer to expiring because there's no value in them. So going back to the SPY example, if price is at 5:15 in the morning when the market opens, the 5:16 strike price calls, they might be at $1, but when it gets closer to the end of the day, if the stock price is the same, so it's still at 5:15 below the strike price, which would be out of the money, they might only be worth 30 cents because at the end of the day, if they're out of the money, they become worthless and will go to zero. So if you are holding out of the money contracts until the end of the day, you'll just lose everything. So if I bought these for $1, at the end of the day, I would have nothing. So premiums is the price of the options. I was saying on the last slide $1.30, but that's not actually the price of the contracts. It'll look like that, so it'll look like 0.89 or 89 cents or 1.12 or $1.12, but that's not the actual price. You actually have to move the decimal place 2 spots to the right. So 89 cents would actually be $89, and 1.12 or $1.12 will actually be $112. So each contract, the cost to buy each contract would be 89 cents. Or $89, I'm sorry, but oftentimes it's referred to as just 89 cents, but in reality it's actually $89. So if it was at 0.89 and it moved up to 1.12, I don't know what that is exactly, like 23 cents. So it moved 23 cents, but that's actually $23. So if it moved up that much, every contract you have would then be, you would gain $23 per contract. Now, exercising options, what I kind of covered earlier, it doesn't apply to trading the options. Exercising options only applies if you hold a strike price to expiration, and then if the strike price is in the money, then you're able to either purchase the stock for the strike price if you have calls, or sell the stock if you have the money. If you have in the money puts at expiration. You need to have a lot of money for this in your trading account to exercise options. They're most commonly used only by like big Wall Street investors or people with lots of capital. I don't do that. I don't think I ever will, honestly. It's not something I need to do personally, but yeah, you don't got to worry about that. It's just there, just so you know about it. Now, looking at Webull, so this is where you would place options. This is what it looks like. I'm going to try and go over everything that I talked about and explain it a little more so it all makes a little bit more sense. So this is the chart here. Again, I don't look at this chart at all. So this is on paper trading, first of all, I should say. So this is all fake money, so you guys can practice this if you want, placing trades when market open. You can't place trades now. Obviously, I'm recording this on Saturday, so the market's not open. But during the day, if you guys want, you can just go on and buy and sell options, see how they work. This is a chart. Again, I don't have this on my on my live options account. I use TradingView, which I went over in the last video. So looking at this, here's the strike prices in the center. It says 2 days because these expire on Monday, but as you can see, 3 days, 4 days, 5 days, 6 days. Every single day they have contracts that expire at the end of the day. So these are the strike prices. See, the current price is 520.84. So it's right here in the middle, and then there's 521, 522, 523, and then below it 520, 519, 518. So if you look, the left side is the calls and the right side is puts. So these calls down here, since it's at 520, which is below the price right now, these ones are in the money. So down here, all these ones are in the money, so that's why they're worth more. These ones are worth, that's at $148, $218. These ones are out of the money, so they're currently worthless, or would be worthless if they were to expire right now. That's why their prices are lower. So it's only $90, $48. When I'm trading, I try and look for contracts that are out of the money going into the money. So if I were buying calls here, if I was expecting price to move up, I'd probably be buying these $90 calls right here, hoping that they turn into the money. They have right around the price of the stock is where there's the most volume, the most change, so you can make the biggest amounts off the smallest moves. Looking at puts, however, up here, these the ones, or the strike price is above the current price since they're puts. Those are the in the money puts. So you can see they're at $111, $167, and then the out of the money ones are at $70, $43. Again, I would probably be looking for like the $70 puts if I were to be buying right now, and then hoping they turn into the money, and I could see a nice return off of a move down. So some other things I'm going to go over. At the top here, you'll see the last, the ask, and the bid on each side. So the last is the current price that the options are worth. The ask is what people who are selling the contracts are asking to get for them. And the bid is what people who are trying to buy them are asking for them. So if you want the safest entry, or like a guaranteed entry, you'd want to buy or pay the ask, because those are what people are currently. I always go for the last, because it'll give you a better fill, a better price, and you're pretty much guaranteed to be filled before price bounces or moves. The bid, however, I don't typically try and aim for the bid, because a lot of times, since it's lower than the actual price, if you start to see the move like that I anticipated, like if I anticipate price to move upwards, the price will start going up, and I wouldn't be filled at this price, so then I would potentially not even be in a winning trade. So you can try and go for bids. You'll get a better price, a lower entry to see greater profits, but it's harder, and sometimes you won't get filled, so it can be a little inconsistent. So if you're planning on practicing or demo trading, I'll go over how you do that. So you go to preferably the last, right? The price, the last price. If you right click on it, You can hit buy. There's a thing called like selling calls and selling and then buying puts. It or it's a complicated thing. Honestly, I don't go try and mess with any of that. I just always buy, just buy and then sell it. Like buy calls and then see it move up and then sell them, and then buy puts, see it move down and sell them. But I'm not entirely sure how the selling. You can sell it before you buy. I'm not entirely sure how that works, but so you just right click on this, buy, and then so this is what it'll look like: a single option, the strike price, the expiration, and then what kind. Obviously, you'd want calls if you're expecting price to move up. You'd hit buy, or have buy selected. You don't want sell selected. You want buy selected. The quantity, you can select however many you want. We'll just do one, keep things simple. So you can do limit orders, so you can set a price that you want to be filled at. So when price moves there. Typically when I'm trying to get into positions quickly, I'll choose market. So that when you buy market, typically it just fills you at whatever the price is or the last price is currently at. So it's you'll get usually a bad fill. So like you might be a few cents higher than what the price might actually be at, but it's easier if there's a move that's about to happen, or it's about to shoot up quick. And because if you were to place a limit order at 149, it just immediately shot up, you wouldn't be in. But if you place market, you'd be in at least like 151 before the bigger move up. And I don't know what happens if I place that. So if I try and place that, then it just has this up here in the working orders, just like sitting there. So like it won't be filled since the market's not open, but at market open, it would be automatically filled. You can modify it. You can just cancel it here, and then it's just gone. And then the same thing would be for puts over here. You buy them, buy put. You can buy at limit, market. There's different orders here that you can do. You can do stops. So these are nice when you're in a trade. So say I have a call and I'm selling my one call. I can put a stop loss. So like if as soon as we hit 80 cents, I want to be out of it. I can also put the profit, right? So I could put the profit up here at like 110. So if we're in between, it's either I want to see us, run up and hit 110 and then sell it, or if we move back down to 80, then I'd be out of it. They're a nice technique. I'll go over later. Again, like when I do my actual trading strategy and my setups and how I actually do all my trading, I'll go over like what I do and when I put stops, when I place limits. We'll go over that in a future video. But you can just mess around. You can explore things. You can see the reason why I trade the same day is a lot of the times when you get farther out, they'll be more expensive. So see these same 521s here, they're $497, but up here they're only $90. So obviously I don't want to pay $490 for one contract, and they also don't move a lot. So if you look here, like the price moving on here, it's like 1%, 3%, but up here they're moving, the change is 80%, 30%. A lot more volatile and able to see higher returns. Alright, that's going to wrap up today's video. I think I did my best to explain everything to my best ability. If you have questions, leave them in the comments. I'm looking forward towards next week. Next week's going to be a little bit of an easier video. It's easier to understanding futures. So it'll be like similar to this video, except futures, and in my opinion, are much easier to understand and cover. And it should be a little bit of a shorter video. And if you're able to understand options, then you should be able to easily understand futures. But we'll go over that next week. If you have any questions, leave them in the comments or ask me in person. It can be a little complicated. There's other videos out there you guys can watch if you want to learn about futures, or if you're trying to figure out how to use Webull more, you can look up tutorials. I'll cover that in a couple weeks, like going over Weeble a little bit more in depth. But yeah, for now, that's pretty much all I got. I hope you enjoyed. It was the best I could do. And take care.